right, good afternoon, everyone. Welcome to today's webinar, How to Prepare for Your Reg A+. This brought to you by Benzinga and the Dalmore Group. I'm Adam Partridge, Director of Partnerships. Really excited about today. Today's webinar, I think it's going to be really interesting for businesses and leaders of businesses looking to scale up. Also retail investors looking to discover some of the offerings on the Dalmore Group site and their issuers. When onboarding clients in this role, it's been really apparent that the number one thing that these leaders are looking for is growth. A year ago, I was asked to head up alternative investments, and through that process, learned a lot. The difference between accredited and unaccredited investor, art, wine, retail investors. And through that process, I learned about Reg A+. With that journey in place, talked to Etan Butler, chairman of the Dalmore Group, and he helped me understand like some of the misconceptions, how to get involved, how companies can scale their business. And in conversations with him, like how our partners, companies out there, or retail investors can learn a little bit more about it. And really that brings us to today. Want to introduce Kevin Vandenboss. He's the managing editor for Alternative Investments to get us rolling. But before we do, just want to give a shout out and let you all know that I'll be keeping track in the comment section if you have any questions. At the end, we're going to have a section where we're going to come back to that and want to answer those. So Kevin, it's all you, man.
Hey, thank you, Adam. Yeah, so today, as you said, we have Etan Butler here with the Dalmore Group, who is, this company is, the leading, broker dealer in the Reg A space. So definitely no better person to be here talking to us today. So yeah, I'd like to welcome Etan Butler here.
Hey Kevin, how are you?
Hey,
good to
great.
be here.
Hey, thank you. Thank you for taking the time to be with us today. Just as to kick this off, if you could just, give everybody, kind of a little bit understanding of, who you are, and what you do.
Sure, thank you. So Etan Butler here. I'm the chairman at Dalmore Group. Dalmore is a FINRA registered broker-dealer investment bank headquartered in New York. We were founded in 2005. We spent the first 10 years or so focused primarily on providing institutional investment banking services to private and public companies in multiple industries. And since the Jobs Act of 2012, we made a shift to helping companies raise capital primarily online at scale through regulations D, A, and CF. And we've been quite active in all those regards over the last number of years, in particular with Regulation A, which we got involved with in late 2018, which is when the industry really started to pick up in activity. And since that time, we've been fortunate to have onboarded over 210 or so Regulation A clients, including a number of the more successful Reg A offerings that have been done. So we've observed what's been working well, what hasn't. It's a fascinating and growing industry, as is Regulation CF and Reg D, and it's become a real specialization of ours over the last few years.
Okay, so for the audience that isn't in this kind of stuff every day, could you explain what is the difference between the Reg CF, the Reg A+, Reg D, these different types of these raises?
Yeah, so these are all exemptions that entrepreneurs could consider utilizing in order to raise capital for their business, right? And there's three primary ones, the most popular ones to consider. The first is Regulation D. Regulation D allows a company to raise an unlimited amount of capital, but only from accredited investors, right? Whatever that percentage is. I've seen it as low as 5 to 8% of the investor population. But it's challenging if you're relying on marketing and promotion to raise capital to be limited to only being able to have an audience of accredited investors only. Whereas if you have identified existing accredited investors, they're in your network, their friends, their family, or their institutions, Reg D might be an exemption to consider. The next is Regulation CF, which is regulation crowdfunding. And that exemption, as of the previous March 15th, was increased to up to $5 million that a company could raise per year from anyone over the age of 18, pretty much anyone over the age of 18. And that's profound, because if you are relying on marketing and promotion, or you're looking to convert an existing ecosystem of customers or followers or subscribers, and you want to democratize access to your opportunity, that's a really interesting exemption to consider, because pretty much anyone could participate, right, over the age of 18. And that's been growing very significantly. But it is limited to $5 million per year, which is sufficient for many startups, just to at least to start with. A step up from that is Regulation A. And Regulation A also allows you to raise capital from anyone over the age of 18, pretty much. But you're not capped at 5 million. You're able to raise up to 75 million per year, right? And another interesting characteristic of Regulation A is, unlike Regulation D and Regulation CF, both of which have a 1-year lockup to shares that are purchased, Regulation A does not have a lockup, which means that there's an immediate path to potential liquidity, provided that there is liquidity. Yeah, there's a path to it. And that's become more and more relevant for certain strategies that are designed to include a more immediate path to secondary trading, which we're starting to see a big increase in recently.
Okay. Yeah, that's really helpful. Thank you. So, I mean, how does a company or startup, choose between these three options? I mean, it kind of sounds like they each have their benefits, depending on, who it is. But, how do you recommend somebody chooses between these?
So it really has to do with the issuer and their strategy. If you're a company just looking for, a few $1 million or a few $100,000, you're not really overly concerned about, how quick these shares could be traded on the secondary, which would be most companies, I imagine, today. Then you're pretty confident that you could identify, investors within your own network, right? Or institutional investors. You may consider a Reg D. Yes, you can't market it to anyone, but if you're looking to raise if you're confident in your ability to identify a few wealthy or accredited investors, Regulation D is a pretty efficient, pretty cost-effective process to set up. It doesn't require SEC qualification, and it's something that can be put together in a pretty cost-effective and timely way. If you don't have an existing network of wealthy type investors, and you want to have the opportunity to market your offering more broadly, or you have an existing base of customers or followers who the majority of which might not be accredited, but you still want to give them the opportunity to participate in your offering, then you're probably going to look at Reg CF, provided that you're looking to raise up to that $5 million per year, right? Again, in most startups, that's a sufficient starting point, right? From a crowdfunding perspective, up to 5 million. See how it goes. And then for more advanced companies who may have maybe already completed a Reg CF and have a level of confidence in being able to get their message out and generate interest, and want to raise more significant capital, a Reg A might be something to consider. There's all types of strategies, though, right? There's companies that are looking at these capital raises from a one-off perspective, right? They need to raise $5 million or $20 million for one deal. That's one profile of a type of investor, regardless of the industry. But there's a whole other set of usages of these exemptions. Like, for example, these these fractional share platforms, right? Series issuers, which I imagine we'll talk about shortly. They're looking to sell assets one after the other, not raise capital for a fund structure or for a specific business. And there's certain unique benefits of Regulation A if you structure the issuing entity appropriately. Then that could really help facilitate an issuer's ability to fractionalize and offer shares in an ongoing number of individual assets or opportunities, while at the same time, right after the offering closes, giving a path to potential liquidity through secondary market trading. So it depends on how much you're looking to raise, and it depends on what strategy you're looking to deploy, I would say. And that's how you make that determination.
Okay. So do you see many companies kind of going down that path, starting with one, moving on to the next, and kind of progressing in that way?
Yeah. Now all the time we're seeing that more and more, and we're seeing companies that are launching a Reg CF and a Reg D at the same time, right? Because they could raise up to 5 million from not yet accredited investors via the Reg CF. But if they want to raise more capital, they may launch a parallel Regulation D, which allows for them to raise an unlimited amount of capital from accredited investors. So on the landing page, you might have, learn more about this offering, click here, learn more about this offering, click there. And it kind of takes investors on a different journey, depending on whether they're accredited or not. We're seeing companies launch a Reg D and a Reg A at the same time. And the Reg D they're using to bring a unique share class structure or investment opportunity more towards, let's say, accredited or institutional investors or VCs. But they're using the Reg A or the Reg CF to present a kind of a retail door into the opportunity. It may be a different structure. It may be a different valuation, and all of which you could do if that's disclosed properly. Sometimes we spend a lot of time talking with issuers up front about what's the appropriate exemption to consider, how long do they take, how much does it cost, what are we seeing work, and how to succeed, how to win, kind of before you start is really the aim.
Okay. So I'm wondering, what kind of companies tend to do well, with this, type of capital raising using crowdfunding?
It's interesting because it comes down to common sense, right? The success of a crowdfunding effort is going to be dependent on how effective you market and promote the offering. This is not a you build it and they come type of strategy. This is you build it, you develop a compelling reason why I should spend my time visiting your opportunity, and present a very clear value added proposition to me, and make it affordable for me to be able to put this investment on my credit card or on ACH from my iPhone. That's how you win, right? You bring a compelling opportunity to enough people that might have an interest. You create a funnel of investors who express some level of interest, and you manage that funnel. I would say that companies that have a large base of customers or are business to consumer brands, like cannabis has done quite well, consumer products has done quite well, technology related businesses have done quite well, real estate has done extraordinarily well, as far as the percentage of crowdfunding that has gone towards one specific industry. I think real estate has remained in first place across all exemptions. So a big base of customers, fans, followers, subscribers, or users. Why? Because they know who you are, and you're giving them the opportunity to come along for the ride and become an investor and an ambassador. Even companies that have celebrities or influencers. Why? Because you're able to leverage their network of fans and subscribers that might learn about you in that way. Groundbreaking technology, extraordinary levels of pre-orders, really good PR, right? Whereas a company that is on the other hand, a company that's a business to business, company that manufactures a tractor part in mid-America that doesn't have any customers, that's a different approach. Not as many people are going to it's not going to resonate to as many people as a cannabis or a consumer products company might, right? Now, there's a different path to win when it comes to that. You got to identify where does this industry reside? Where do these types of investors reside? How do I get in front of them? And what's the right message to take to them? So it really the marketing and promotion is really key here, and the marketing and promotion changes and fluctuates depending on what the ideal demographic of the investor that you're looking to reach represents.
Okay. Now, what about, I mean, I've seen a number of the issuers on your site. These are, a lot of them are companies that really look like they're about to do some really big things. They already are doing big things. What about some like the more local businesses? So maybe like a local, I don't know, coffee chain that's got a few locations. I mean, do these types of companies, typically do well with crowdfunding?
Local companies can do well, provided that they effectively market and promote the offering in the same way that a national company might, right? In other words, a local company could theoretically do better than a larger company with better marketing and promotion, right? And that's really what this comes down to. It's how do I get as many people as possible who might care about my investment opportunity to my landing page to check me out and make a decision, right? And that's how you win. Local companies, there's a number of Reg CF funding portals out there. I think the number is over 60. So, we focus more on the larger side of the market, right? For Reg CF, we're typically looking to work with companies that are looking to raise, a minimum of 3 million, usually that 3 to 5 million on a CF, with ambitions to launch a Reg A after. Companies that are looking to raise $1 million or less, there's a number of funding portals out there. Some of them specialize actually in kind of community rounds and community type smaller offerings, even as low as $50,000, $100,000. You're looking to raise a $50,000, $100,000, it's a totally different proposition, right? You may have a very low investment minimum, a few $100s, and you may be able to go right to your customer list that really likes your Reuben sandwich on Tuesday nights and say, hey, look, we're looking to open up another store, and we're going to give you 10% off for if you invest over $500 in our offering. That might be sufficient. Whereas our raises tend to be, our issuers raises tend to be much higher than that, and really require, I guess, a more sophisticated, advanced way of approaching capital raising, which if they don't have adequate in-house marketing capabilities, usually involves considering hiring others who do, other marketing companies, promotion companies, PR firms. So we're always monitoring who is doing what for who, and who has worked well with others. And oftentimes we're asked for our advice based on our experience of effective marketing and promotion strategies and providers, which we help our clients with.
Okay. How are these investments structured? I mean, are they like equity investments? Is it, some type of note, or are there dividends involved, or how are these set up?
So every platform looks at this differently, and some require specific structures, right? There are some marketplace platforms that require safe notes or preferred, equity. Our approach is we look at these exemptions as a tool that enable issuers to take a unique share class structure to the masses, right? Which is very different. So we're somewhat agnostic to the structure, whether it's debt, whether it's equity, whether it's voting, non-voting, common, preferred, safe notes. As long as it is legal and our compliance team is comfortable with the strategy and the issuer, we're generally going to be pretty supportive as far as the share class structure. And so, it varies. I mean, you have things that are as vanilla as REITs, real estate investment trusts, that are offering yield to investors. That's pretty vanilla, right? And you have things that are exotic as, cannabis and psychedelics and blockchain related businesses, et cetera, that are, super exciting, and collectibles and all these types of things that we're doing. So it really spans the spectrum. But again, we look at this as a tool that issuers could utilize to raise capital from anyone over 18 at really their own terms and their own structure.
Okay. All right. Thank you. Um, how much time goes into this? You know, so if I'm ready to, raise capital for my company, how much time do I need to spend preparing, to launch, whether it's a Reg A or Reg CF?
So a Reg CF, it doesn't require SEC qualification. It requires a notice filing. So you could launch a Reg CF pretty quickly in a matter of weeks, right? There's due diligence, there's the build out of the offering page, and there's the required filing of what's called a Form C. But once these things are done, and obviously the audited financials, if a company is looking to raise over 1.07 million for a CF, but once those things are in place, you could, in most cases, expect to be up in a matter of weeks. Whereas a Reg A, it's months, right? You need the audited financials, but you also have to hire a securities attorney who's going to structure and draft this pretty extensive offering circular that ultimately needs to be submitted to the SEC seeking qualification. It's called a Form 1A, and they're listed on every Reg A offering that you'll see out there. They need to be. And that takes some time. The SEC could, respond with comments. There's sometimes back and forth. So that could be 4 or 5, 6 months, in some cases. Reg D is something that can be done very quickly, right? It's really just having the adequate offering docs and kind of corporate materials in place. You don't need audited financials for that. So that's something that could be up and running quick. But in general, I like to say, that's how long it takes to go live. But you want to spend as much time as possible strategizing of how to win, as well. It's not just about getting to a point of live. It's understanding, what type of budget do I need for marketing and promotion? How do I leverage my existing ecosystem? What are financial publications and newsletters, and how do you get into them, and how do you get considered by them? What are influencer networks, and does it make sense to involve a celebrity partner, provided it's compliant? What about co-listing? Does that exist? Can I get my listing, co-listed on other platforms? Dalmore's approach is very unique for Reg A and Reg CF. An issuer has a important consideration to make. Do they want to list their offering on a growing number of marketplace platforms where their offering might be one amongst many other oftentimes competing offerings? Or do they want to list their offering on a separate on their own website, right? And therefore become the sole beneficiary of their own marketing and promotional efforts, right? And so if they have a large base of customers, followers, fans, subscribers, they may want to have their offering on their own domain so that they could direct all of those individuals to their own website where there's no distraction, there's no homepage with other trending deals that are way more interesting than theirs, where they could have that direct relationship and communicate to their investor base. If they're heavily reliant on marketing and promotion, same thing, right? There's a benefit in leading people to one option, which is your opportunity, and you could follow up with them directly, as opposed to leading folks to a marketplace where they register and then they start viewing and shopping amongst many other oftentimes competing offerings, right? So there's that decision that folks have to make. Do I want to have the psychological comfort of listing on a marketplace that says they have hundreds of thousands of subscribers? Wait a minute, I might be discovered. I might not have to spend so much on marketing and promotion if their investors invest in me. I wouldn't recommend that as a strategy to just to assume that you list and then you're bombarded with investor interest, although it's a possibility. What we're focused on is kind of how do you have your cake and eat it too, right? How do you have your offering on your own domain where you pay much lower commissions, where you're the sole beneficiary of your own marketing and promotion, and now you're at a position of strength, right? Now your PR, your advertising, your own family, your mother, your institutions, everyone's going to your site. That's all they're seeing, your site. Now, okay, a marketplace platform, what could you offer me? Not what are you entitled to with me listing on your platform, a higher 7-8% fee. But if you could deliver me investors from your platform, yeah, no problem. I'll pay you a bigger fee. But that's an example of how to syndicate or co-list a Regulation A offering, right? Because syndication doesn't really exist so much in Regulation A. There are very few retail brokerage firms out there that are calling their book of business with, hey, I have a $1,000 investment opportunity that's non-voting common, right? It's a very different proposition than what you see in the Regulation D world historically, which is I have a $100,000 opportunity. Here are the comps. Here's the process. So where do these syndicate partners exist? They exist kind of online, and they're consolidated amongst a number of platforms that do a great job of building their base of subscribers, of users that are looking for opportunities. So the key is, if you can figure out, which we spend a lot of time doing, how do you launch on your own site, and how do you syndicate and co-list on marketplace platforms? That's a really interesting proposition, and we're really leading the way in that regard. We have a number of pretty high profile co-listed opportunities currently that are on multiple platforms. Some of them are doing quite well. And that's, we look at that as the future.
Okay. With these, with these campaigns, how long do they typically run? I mean, obviously, I know you talked about somebody raising 50,000. You talked about people raising 75 million, but let's say I'm trying to raise $10 million. And I plan on marketing and everything. How long should I really, expect that to take?
You want this to take as quickly as possible, be as quick as possible, right? You want this to be so if you have a very large base of followers or subscribers, you may be able to, complete a round of that size in a period of time. You have a year, right? You have up to a year to raise that amount. I would say most issuers do not hit their maximum offering goals, right? Usually it's somewhere in between. There are some that, there are exceptions on both sides. We had a cannabis company actually that raised $50 million in around 3 months. That's an exception. Don't expect that to happen with your offering, anyone who's listening to this. But it's an example of how, the possibility of that happening. Now, there's always a reason why, right? They had a big institutional investor that participated in the Reg A, and perhaps that broadcasted whatever it did to the retail market that gave them comfort to kind of fill the balance. On the other side, there are companies that are struggling to get an adequate return on advertising spend. This doesn't always work, right? So that's why if you build this and you don't have an adequate marketing budget or adequate marketing plan, right, then you're going to have challenges. And if you are solely reliant on paid ads and digital marketing, my experience is prepare for a bumpy road, meaning it prepare for this to be longer and more expensive than you might have hoped for, right? And it's important, and we don't like wasting our time or wasting issuers' time. We like to talk about, have a very blunt discussion up front about what it takes to win. And you want to really be creative. You want to leverage as many strengths as you can. And then you obviously want to consider hiring a marketing company that has experience in succeeding with similar type offerings in the past. And you want to kind of do all that before you make a decision to move forward, right? So our model is, let's just tell you everything that you need and share all of our resources. You don't have to sign up with us. You don't have to, you need to be equipped with all this information, and you should expect it. You want to work with a company that's done this before and that's very free with their information and guidance up front. You really want to have confidence in the success of an offering before you take the time and make the investment in going down that path. And that's really been our approach.
Okay. One of the things you brought up a few times is, by having a company having the offering right on their own website. So
Yeah.
I'll say Benzinga is doing an offering. We have it right on the site. But how do we do that? If we go through a platform, they've got all the back end stuff, taking the payments, I'm sure there's some sort of escrow. I mean, I don't know, but if I'm just raising money for my company, how do I get that done through my website?
That's a great question. It's kind of like a Shopify-like experience, or like an Amazon Prime-like example, where we would install a technology, a invest now button on your website, right? And it would be on your website. It would be white labeled on your website. This is for Reg A. Reg CF is a little bit different, but Reg A and Reg D, it would be right on your own domain or domains or app. And someone clicks on invest now, and it would open up that box where it would say, what is your name and email? And then, are you accredited? Are you not? And what's your social? What's your address? How much are you looking to invest? And ultimately, have you electronically sign a subscription agreement? So this would be attached to a back-end portal that you, the issuer, would have access to. And we, the broker-dealer, would facilitate and obviously have access to as well, so that we could do our job on the compliance side, right? And that would be ultimately attached to a transfer agent that would manage the cap table and hold the shares for the investors. And so it's pretty, out of the box right now. There's technology that we have and others have that enable a company to really integrate a investment button on their site, right? Obviously, once they're qualified with either of these exemptions, there's a whole regulatory component that goes into this, and what is on the site and what information we need. But there's a built-out back-end portal that allows for you, the issuer, to integrate your CRM into that process, so that you could systematically, in real time, communicate to your investors. Thank you for investing. We saw that you made payment, but you didn't sign a subdoc. Here's a link to continue the process. There's a funnel that ultimately needs to be managed, and it needs to be run in a professional fashion, because many investors start a process but don't complete a process, right? Especially when you're asking for money, people tend to start things and get distracted. And so having that automation and that follow-up and that IR that goes into managing that funnel is very important. As it is, as much as it is in getting them to the landing page in the beginning. It's following up to make sure that they, that they're reminded of where they left off and encouraged to consider continuing. So that allows for you to kind of host an offering on your own domain.
Okay. Now, what about the minimum investment? The Reg A. I've seen things kind of all over the place. Different campaigns I've looked at. How does a company decide where to set that minimum and get that balance between being able to get literally anybody to invest if they've got $50, but also keeping, I don't know if they want to keep the number of investors lower, or what some of the motivation is for a little bit higher minimum.
Yeah, that's a great question. And it depends. I mean, the averages that we've seen are, the investment minimum for like a Reg CF would be 300 to, let's say, 1,000. The investment minimums for a Reg A might be on average 750 to 2,000. So you generally would see a higher investment minimum on a Reg A, and then the investment minimums on average for a Regulation D, in my experience, they're usually around 25,000, sometimes less, sometimes 10,000. So you tend to so the exemption itself could give you a little bit of data as far as what others are doing and what's worked in the past. What's important to understand is that our experience is that you don't want to make the investment minimum too low, because the average investment amount tends to be just above the minimum allowed. So if someone was, would have been perfectly comfortable investing $500 in your offering, and your investment minimum was 250, they might say, okay, great. I want in, and I could get in for 250. So I'll invest 250. So you want to, it's a balance of not wanting to leave people out by having too high of a minimum. And also not making the minimum too low. If you're looking to raise millions of dollars and you have a few $100 minimum, you start doing the math. You need tens of thousands of investors. There's that balance, and there's no magic bullet to it. It depends a lot on what the ambitions of the issuer are. Is it more important that if you're a consumer brand, do you have more people who become investors and brand ambassadors because they'll think more about you and they'll feel more engaged? There's a value in that. And therefore, you may consider a lower investment minimum, because it's not just about the money. It's about having them feel like they are an investor in your company, right? And the money, of course. It's always important. So you may want to make it easier for every one of your customers, or users to be able to participate, right? There's a value in that. It's a real community component to that. Not everyone can put $1,000, into an investment. More people can put $300, right? So you need to look at kind of what some of the other successful offerings have done that are somewhat similar to yours, and kind of see the art of what's possible or what other people are doing. And on the flip side, if you're a fractional share issuer, and we have about 35 or so of these platforms, then you'll start seeing share prices as low as $5 a share. But there's a reason why. These aren't one and done capital raises. These are issuers utilizing Reg A typically that will get qualified for the same 75 million a year, but they're a series issuer. They're series LLC structures. They're releasing an ongoing number of individual assets, of Michael Jordan rookie cards, of racehorses, of cars, of Rolexes, of NFTs, even dinosaur bones and single family homes. And they're giving the investor the opportunity to build a portfolio. I want to buy shares of this, but not that. I want to buy shares of that, but not that. And here's my dashboard of all my positions. And here's my ability to offer those shares or buy more shares after the offering closes. They're building communities. These are not one and done $20 million cannabis raises that are off to the next, and hopefully you see them on, going public one day, right? These are, they're using Reg A as a business model. It's ongoing, as do the REITs, the real estate investment trusts, right? These aren't just these are perpetual, right? They're looking to raise up to 75 million per year on an ongoing basis, right? They're offering yield, and there's scalability to that component. So they're approaching Reg A differently. So it's a great question as far as, what the minimum should be. We like to respond with, here are the averages, and here are the pros and cons. And oftentimes you want to include your marketing company in that decision, right? Because they're the ones that you want to include up front, so that they could help you craft your messaging, your offering page, your landing page, who your demographic is or should be for your product, and therefore what the minimum should be for that demographic, right? So there's some thought that goes into it from a marketing perspective that's important to consider up front as well.
Okay. So if somebody has an offering going right now on a platform, if they have a Reg CF, could they switch? Could they end up moving over and doing something on their own site, by using somebody like you?
Yeah, and it happens all the time. A company wants to raise $5 million through a Reg CF. They sign up with one of the marketplace platforms, and they raise $30,000. And they're like, wait a minute, $20,000 came from my mother and $8,000 came from my neighbor. Like, I get it. I'm going to actually have to market and promote this. I can't just wait for magic to happen. And if that's the case, why am I spending money marketing just to send all those investors to a third-party platform that operates like a mall, where these investors could shop amongst multiple opportunities and trending deals and things that are maybe more interesting than mine, and perhaps forget about who sent them there and who paid for that ad, and then be bombarded every day with new opportunities. So that's a reality that happens frequently from our perspective. Yes, you can, as a Reg CF issuer, you could raise up to $5 million per year So you could, in that example, they would start for the year, they'd raise $30,000. They would then say, wait a minute, I need to do this on my own. I need cheaper, lower cost fees, and perhaps more importantly, I need full control over the analytics. I need to be able to page tag and pixel and heat map so that I could properly determine the effectiveness of the marketing and promotion that I'm responsible for. It can't be opaque where I'm leading people to a third-party platform and judging the success based on how much money is raised without having that granular visibility. Because then how do I pivot, and how do I know what marketing techniques are working most effectively? How do I measure my return on advertising spend and my conversion metrics? And how do I have access to my investors and communicate with them efficiently, rather than relying on a platform to do so and with their own intentions? So, that's absolutely possible. You could raise the other 4.96, whatever that number is, on your own dedicated domain. That happens frequently. And it happens vice versa. It happens the other way too, right? So someone might say, I have enough confidence to market. I'm going to go and try to raise 5 million on a CF. And it's harder than they think. And they're not getting the momentum that they want, or they don't have the budget that they need. And they're like, wait a minute, I saw a company like mine on this platform that did well. Before I give up, I want to try to kind of list on a marketplace to see if I could get some momentum. And perhaps it works, perhaps it doesn't. But the point being is that you are able to switch horses, both for a Reg CF and a Reg A. You want to take a look at the agreement that you signed to see if there's any implications of doing that. But from a regulatory perspective, it is possible and is done frequently.
Okay. Yeah, that's really helpful. So I've got about another 3 hours worth of questions here that I want to ask you, but I think we might have some questions from the audience. So I want to make sure we have a chance to answer any of those. We'll bring Adam on, and he can share any questions he's received while we've been here.
Etan, man, unbelievably informative as usual.
Thank you, brother.
So there are definitely a few questions in the chat, and I'm kind of going to separate them out. One side's the investor focus, the other side kind of more from the business side. From an investor, the investor questions specifically, there's a few of them. We can kind of quick hit them, or you feel free to expand. But one of them was, do you have to be an accredited investor to invest in any of these? But I think it was specifically around Reg A.
No, you don't. The only time you have to be an accredited investor is in these cases are for Regulation D offerings, right? But for Regulation A and for Regulation CF, you are able to be I call it not yet accredited. Now there are limitations to how much a not yet accredited investor could invest, right? For both Reg CF and Reg A, it varies differently, but it has to do with your stated annual income and net worth outside of the value of your home, which is always going to be explained when you go through a checkout process. And so that's really designed to protect retail investors that might not have a lot of experience in investing from getting too ahead of their skis, right? Where this needs to be looked at as risk capital. You need to assume you're going to lose, right? And because most businesses historically have failed. And but the flip side of that is it gives you the opportunity to support something that's meaningful to you. It gives you the opportunity to invest in something that might become the next big thing, right? At a very early stage, or to access yield-based opportunities that otherwise were never on your radar, and to become your own mini VC investor, $100 here, $100 there, not $10 million here and $10 million there. But that's what Reg A, that's what the Jobs Act really helped open up, which is democratization to investment opportunities for people who in the past had a very difficult time accessing them, or weren't able to access them in some cases, and also to the entrepreneur who in the past had to rely on institutional buy-in or VCs, right? This is my terms, take it or leave it, right? And if you're a female-owned business or a minority-owned business in the U.S. historically, it is embarrassing the small percentage of capital, of VC capital, private equity, institutional capital that has gone in to support your business growth needs. This has really done a good job in helping level the playing field, because any entrepreneur today that qualifies could take advantage of these exemptions and could reach their community directly. You don't have, these are my terms, this is my structure, this is my offering, this is my marketing message to my community. Take it or leave it. But it's not, I have to go get the attention of a Wall Street banker that's going to believe in me and going to perhaps take advantage of me. It really levels the playing field. And that's really one of the more exciting things about Reg A and Reg CF. You do not have to be accredited, and you don't have to raise money only from accredited. There's really a mix of both that are involved.
Nice. And this is a really interesting angle on this question. I had not thought of this. But the question that came in was, is it often institutional investors are getting involved with these companies?
No, it's the opposite. It's oftentimes retail investors are getting involved in these offerings. And that's one of the main reasons why folks consider launching a crowdfunding effort. It's to reach the crowd, right? It doesn't mean that institutional investors can't participate. And I gave you an example, a one-off example that no one should expect to happen to their offering, that where a huge institutional investor did participate. Again, this is a tool that enables an issuer to bring a share class structure to the masses. It could be a non-accredited group of investors. It could be a very large institution, right? Both could participate. Now, the reality is that because the investment amounts tend to be much lower, and because perhaps the valuation techniques and the share class structuring tends to not necessarily be what larger institutions would consider, right? Because most larger institutions are not looking at non-voting common, right? They're looking at valuation differently. They're looking at structure differently. They're looking at covenants differently. And that's why you see a different type of offering structure that's brought out through crowdfunding than you would if you were approaching VC investors. It doesn't have to be that way. Some of the platforms out there are opening up what we call community rounds. And I love that, because that brings the same share class structure that VCs and institutions are investing in, and gives a small slug of that to retail investors. That's beautiful. I mean, that's how it should be, right? That's ultimately how it should be. There should be room for everyone kind of at the same structure to participate. And there should be that comfort for retail investors that, hey, smart money, VC is actually in at the same structure. They've done their diligence and they've made a decision to participate. That's something that would be comforting to me, rather than I'm the first one that's making a decision to believe in what I'm being marketed to by this company. So kudos to the platforms. You guys know who you are, who are helping to grow the new terminology about community rounds. I think that it's just the beginning of that.
So I want to take the last few minutes we have. So just an FYI to those folks that are watching, if you have any questions, throw them in the chat really quick. If you haven't had a chance to, but Etan, here's for me. Again, I started with talking about the partnerships that we have at Benzinga. We have hundreds of companies that I think could benefit from the things that you do. I think that there's potentially thousands more that will find this after the fact on YouTube, right? So what is the call to action, right? Because I'm thinking about these companies out there, different industries, cannabis, psychedelics, crypto, electric vehicles, alternate investments. What is their call to action? I kind of get the feeling in some of these conversations that they're like the kid that's trying to jump into the jump rope, right? Like, when do they go? How much do they have to learn? What is their first step? And so I'm just, with them in mind, that's what I would love to close it out with from a question standpoint, is like, what would your conversation be with those companies as far as the next step? And then ultimately, if it is getting in touch with you, how would they do that?
Great question, and a great way to wrap up. I would say that we have now over 27 million private companies in the U.S. I believe that probably many of them haven't yet even heard about this alphabet of like CF, A, D, and maybe it's the first time that they're looking into it. And I think we kind of explained generally, what those are. I recognize in the U.S. that there are many companies that have graduated from Kickstarter and Indiegogo that are now starting to think about equity crowdfunding, and they're doing their research, and they're going to come across a very important consideration. Do I want to try to get to list? Let's say I want to raise $5 million. I could launch a Reg CF to start. What's the ideal path to raise $5 million if I go a Reg CF? Should I try to get listed on one of the top 3 or 4 kind of marketplace platforms? What are the pros and cons in doing so? Do I have any inherent characteristics, qualities that should make me feel more confident about doing this on my own domain? Do I recognize the importance of marketing and promotion to succeed? What I would say is, I look at Dalmore as representing an alternative path to companies who are looking to raise capital for their business, whether it's through Reg D, if you're confident in being able to reach enough accredited investors, or Reg CF, if you're looking to raise up to $5 million from anyone, or Reg A, if you're looking to raise up to $75 million. Regardless of what stage you're at, you could be a startup with a great idea and strong marketing to convey that idea, or you could be a more established company that might be right pre-IPO, and you're looking for that $30 to $75 million slug at your own terms, at your own structure, perhaps to increase shareholder base to meet listing requirements, right? And maybe you have a large network of customers and fans, and that marketing of your offering will also benefit the marketing of your consumer products, right? So depending on regardless of where you are, whether you're a startup graduating Kickstarter, or whether you're a more advanced company that has a large network in their CRM that you believe would be interested potentially in looking at your opportunity, we could be helpful in helping navigate that path. What we present is a very straight up discussion early on about what we're seeing work and what we're seeing not work. We're very helpful as far as which marketing companies that we're seeing work well with others, which PR firms to consider. What are the advantages of marketplaces? Can you set this up so that you could co-list and take advantage of both? Like I mentioned before, right? Can we do this on our own domain for a lot less, and then direct everything there and have the benefits of that, but also co-list and have a syndicate of others actually doing this? Does that exist? What about the OTC companies, 20 plus that are working with us, that are adding warrants to their share class, to the share price, and then freely marketing to anyone over 18, to buy the shares in those? There's a lot of interesting things going on, our website we try to do a good job in just kind of laying out, the differences between the exemptions, examples of other clients that have worked with us and are working with us. But there's a whole lot of information out there, and there's a whole lot of people out there that are saying a whole lot of things. Personally, I see value in learning from folks that are actually doing it, right? Not selling you something, but more talking about what actually is happening, and could really provide a balanced view of the different options that you have in front of you to consider. So hopefully, we could be that resource. Are pretty easy to find online. I'm pretty easy to get in touch with for folks that that have educated themselves to an extent and are kind of ready for the next level of discussion. And which we're happy to have. And I would encourage them to reach out to us. But that's really how I would approach it. It's something that right through the pandemic and right through geopolitical uncertainty and events that we're experiencing right now, has really been growing throughout, right? It probably would have been growing a lot more if we weren't dealing with these challenges. But the growth right through COVID and right through what's going on today doesn't feel to me like it's been slowing down. And whereas the traditional capital markets obviously have, right, with uncertainty and with volatility and what's going on across the world, that does have an impact on the financial markets. And so you can't stop the entrepreneurial drive of American companies. And now that they have this tool, now that they could from their own living room launch a campaign for their business and accept investment from pretty much anyone over the 18, it's done in a regulated way. That's really powerful. And it's still new. In other words, some of the adjustments to these exemptions that have taken place in 2018 and even 2021 are just now are maturing now. And the sophistication of issuers has increased, and there's a lot of information available online. And if you want to talk with someone that's doing this, really all day, reach out to us, and we could be helpful. And take a look at some of the companies we're working with on our site, and research their structures, right? Like if they're Reg A's, you could look at the actual 1A. You could see all their disclaimers. You could see how much they're paying for law firms and how much they're paying us. It's all, the beauty here is there's transparency. And that's what this industry is about. It's about transparency, it's about compliance, and it's about best practice. And that would be my advice. Perfect.
Absolutely perfect. Etan Butler, Chairman, Dalmore Group, thank you so much for being a part of this webinar today. And hope everyone has a good afternoon. Take care.
Thank you, guys.
Hey, thank you. All right.